Welcome to The Explainer. Today, we're taking a massive, honestly pretty dense document, the Federal Reserve's May 2026 Financial Stability Report, and we're translating it into a cinematic, high-stakes look at our economy's resilience. I want you to think of the U.S. financial system as a sprawling, heavily fortified castle. Our goal today? We're going to inspect the walls, look for hidden structural weaknesses, and then turn our gaze outward to the storm clouds gathering on the horizon.
Okay, let's dive right in. Because to really understand the U.S. financial system, we first need to wrap our heads around its sheer scale, its crazy complexity, and just how intensely everything is connected on a global level. We're talking trillions of dollars moving globally in the absolute blink of an eye. A tremor in one part of the world can send shockwaves directly into our domestic markets. But before we start hunting for those tremors, we kind of need to establish what we actually mean when we say the system is stable. The Fed actually sets the stage with this really precise definition of stability, and I love this because it grounds us. You see, stability isn't about perfectly avoiding bad days. It's about endurance. It's about the ability of banks, lenders, and markets to just keep the economy moving, keeping those mortgages flowing, keeping business payrolls funded, even when the unexpected strikes. It's literally not about the absence of stress. It's about the ability to absorb it. So, to make sense of all this, you have to understand the rules of the game here. The Federal Reserve splits its monitoring into two totally distinct categories. On one side, we have vulnerabilities. Think of these as the measurable cracks in the fortress walls, things like high debt or inflated asset prices, that we can actually track as they build up or recede. On the other side, we have shocks. These are the lightning strikes. They're inherently unpredictable adverse events that trigger the stress in the first place. Put simply, we can't predict the lightning, but we can measure the cracks. All right, let's get into it. Chapter 1, High Asset Valuations. Let's start by sizing up those fortress walls and looking at how much things cost right now compared to their historical norms. And when you look at the data, the monumental scale of these markets really jumps out at you. I mean, just look at the numbers from the end of 2025. Public equities sitting at a staggering $83 trillion. Residential real estate is nearly $60 trillion. Meanwhile, commercial real estate, which gets a ton of buzz in the news, is comparatively smaller at $22 trillion. This gives us a really tangible sense of the system's sheer weight. If a market like public equities experiences a sudden drop, the volume of wealth affected is just enormous. But here's the catch. Despite this massive weight, the cost to buy in is incredibly steep right now. If we look at the forward price-to-earnings ratio, which is basically how much investors are willing to pay today for a company's future profits, equity prices remain incredibly high relative to those expected corporate earnings. The numbers are hovering right near the very upper end of their historical norms. Actually, the compensation investors are demanding for taking on the risk of buying stocks over safe government bonds is near a 20-year low. That indicates some seriously elevated valuation pressures. In simple terms, if investor risk appetite suddenly drops, there is a long way for prices to fall. Moving on to Chapter 2, Consumer and Business Debt. Now let's step inside the fortress and examine how everyday businesses and consumers are actually handling their borrowing. High debt burdens are a problem because if incomes drop, spending gets slashed, and that ripples through the entire economy. And right now, we're seeing a really mixed reality. At the macro level, things are surprisingly strong. Total debt for businesses and households as a fraction of GDP is actually falling. It's down to levels we haven't seen since the early 2000s. Overall mortgage delinquencies are low, mostly protected by big home equity cushions. But if you zoom in, you start to see the growing cracks. Auto loan and credit card delinquencies are stuck at high levels relative to the past decade. It's essentially a tale of two economies living inside the exact same fortress. And we see a strikingly similar split on the business side too. The largest investment-grade corporations are absolutely thriving. The report even points out that giant cloud computing firms effortlessly issued nearly $100 billion in bonds recently. No sweat. But step away from the corporate giants and riskier businesses, especially the ones relying on private, floating rate credit where interest payments wildly fluctuate with the market, well, they're feeling the squeeze. As interest rates jump, their debt servicing costs jump right along with them, and that puts their ability to repay under some really intense pressure. Which brings us to Chapter 3, Hidden Financial Leverage. So, the regulators overseeing all these complex markets are constantly hunting for hidden leverage. Leverage is basically using borrowed money to amplify your returns. And it's a fantastic tool when markets go up. But regulators are tracking how it could act as massive rocket fuel during a sudden shock. Because if these institutions hold way too much leverage, a sudden loss forces them to drastically cut lending or sell off assets at fire sale prices. And that ultimately hurts everyday households and businesses.
And what they're finding is a stark, absolutely crucial contrast. The traditional banking system, the real bedrock of the economy, is remarkably sound, heavily fortified with near historically high regulatory capital. But the non-bank actors? Totally different story. Hedge funds are currently carrying leverage near all-time highs, and it's heavily concentrated in just a few massive funds supporting strategies in treasuries and equities. Even the largest life insurers are carrying leverage well into the top quartile of historical norms. So the banks are wearing their heavy armor, but other key players are walking a very, very thin tightrope. Chapter 4, Funding and Liquidity Risks. Now, this is all about the danger of a sudden run, when spooked investors demand all their money back at the exact same time. Fortunately, one of the most terrifying vulnerabilities of the last couple of years has significantly eased up. Domestic banks' reliance on uninsured deposits, which, if you remember, were the primary fuel for all that regional banking stress we saw back in early 2023, is now well below those peak levels. Banks are holding on to high levels of highly liquid assets, meaning they actually have the hard cash on hand if depositors do come knocking.
However, the Fed is definitely tracking some moderate funding risks creeping through the less visible parts of the system. For example, certain non-traded business development companies, or BDCs, have faced such intensely high investor redemption requests, mostly due to underlying asset concerns, that they've actually had to put limits on those redemptions. At the exact same time, we're seeing massive amounts of cash flowing straight into government money market funds, which is actually a good thing. Those are historically way less fragile and way less susceptible to panic runs.
Finally, Chapter 5, Shocks on the Horizon. We've inspected the walls, right? The debt, the leverage, the liquidity. Now we're going to look outward at the dark storm clouds in the distance. To figure out where the next lightning strike might actually come from, the Fed conducts a survey of salient risks. They basically ask market contacts, the folks living and breathing this data every single day, what they fear most over the next 12 to 18 months. And this shifts our focus entirely from those measurable cracks in the wall directly to the unpredictable shocks that could strike our system out of nowhere.
The data here perfectly captures what the market is sweating right now, with some massive leaps in fear from just 6 months ago. A staggering 75% of experts now cite geopolitical conflict as a major risk to U.S. financial stability. 70% fear a sudden oil shock, and get this, that's up from literally 0% in the previous survey. And debuting as a major concern, half of the experts surveyed are sounding the alarm on the totally unpredictable impacts of artificial intelligence on our financial infrastructure. But trailing right behind those massive, sudden shocks, we've got this number, 45%. That is the percentage of surveyed contacts who are still bracing for the persistent, grinding pressure of inflation. It's not a sudden lightning strike. It's more like a slow, relentless storm that just keeps interest rates high and constantly tests the debt burdens of everyday consumers and businesses alike.
So, what does this all mean for us? The U.S. economic fortress is fundamentally stable today. The banks are well capitalized, and overall household debt to GDP is sitting low. But with high asset valuations, deep pockets of hidden leverage in hedge funds, and rising credit card delinquencies, those cracks are definitely there. As geopolitical tensions, potential energy crises, and AI storm clouds gather on the horizon, we are left with one absolutely vital question. The fortress is ready today, but which unpredictable shock will be the ultimate test of its resilience tomorrow?